Hi guys, welcome to today's video. So let me start today's video by showcasing this chart. This is one of the most important charts that I will show. So what you would notice from this chart is that there is a relationship between interest rate cut. For example, this Fed pivot means that the Fed changed the interest rate. And this line indicates the stock market rise or fall. So for example, if you take a look at 1970s, what you would notice is that the interest rate was here, then it was cut. And as a result, the market also fell. Now, something similar happened in 1980s also, that okay, the interest rate was high, then it was cut, correspondingly the market also fell. अब थोड़ी नई बात करते हैं. For example, let's go to 2000 or just before 2000, interest rate was high, then it was cut and the market also corrected by 51%. Something similar happened in 2008, then something similar happened in 2020. And every single time the interest rate was cut. Now this is the Fed chairman. He has recently announced that this September the interest rates in the US are going to get cut. Now does that mean that the market is also going to fall? Well, the answer is a little bit convoluted and complex. So I studied a lot of data on this and I'm also rebalancing, realigning my portfolio, taking certain cash hedges, which I will speak about on this video. So I will give you a complete understanding of it. Now I know that many people just simply skip through these type of important videos. So here is a very quick summary for them that number one, it's critical to build cash hedges right now. I am doing exactly the same. This is something that I keep on guiding my students also on member community, on my courses, etc. about building cash hedges right now. This is absolutely critical. You need to understand this concept. Number 2 point, this is not the time to stop investing in the stock market. Every person, right, I mean that you will speak with, everyone is saying, you know what boss, the market is overvalued. Hoga, I don't know, right? But the point is that no one can guess when the market might start correcting. It might go up by another 30% and then correct by 20%, or it might correct by 20% right away. This guessing game, no one can exactly do. Number 3, it's absolutely critical to understand what overvalued assets are at this juncture. For example, if you consider the US small cap index, which is called as Russell 2000, and look at the chart here, you will see that it doesn't look overvalued. But if you look at the small cap, right, in the last 1 year, I myself have personally booked 90% run up in that I saw and I booked my profits on it. So I feel that small cap index in India is overvalued and usme risk factor is more. So getting out of these type of assets is absolutely critical. So let me help you understand the entire investment story by using very simple logic, facts, commentary, and let's go point by point. I will make it very brief. So let's start with the recent history of interest rates in the US and the relationship it has with India. So whenever the interest rates in the US is high, even the base interest rate in India is high. Now, when I say base interest rate, this is the parent or the mother interest rate. इसके around ही सब कुछ designed होता है. For example, if the base interest rate in India is high, then your home loan rates, जिस पे आप borrow कर रहे हो home loans के लिए, that is also high. Your car loan rates are also high. Your education rates are also high. If you run a business, then if you go and borrow money from the bank, then again, the loan rate at which you will be getting that money will also be high. When interest rates are cut or the parent interest rates are cut, then all these rates also come down, right? So this is the absolute basic point around it. This all is decided by the US in a way, and India follows that policy also. Whenever US raises the interest rate, India typically follows that policy. And whenever the US cuts interest rate, India also follows a similar policy. So for this reason, I am going to show you a lot of data from the US. It is equally applicable in India also. So on that note, let us very quickly touch upon this data point, and this shows the recent history of interest rates in the US. You will see that somewhere around 2014, we were at close to 0% interest rates or base lending rate in the US. Right now, this number has come out to be 5.5%. It has peaked, and now Jerome Powell, who is the Fed chairman, he has said that, you know what boss, September onwards, we are going to cut interest rate. Why? Because inflation is done. We have tamed inflation. इतनी महंगाई की problem अब नहीं है. So therefore, we can afford to cut interest rates. Now normal logic comes कि okay, when interest rates are getting cut, that is good news for the economy, good news for the stock market. Then okay, why is it that the stock market typically corrects? So there are two things that you need to know. The first concept is called as factoring in of interest rate. Now factoring in of interest rate means कि यार देखो ये वाली जो बातें चल रही हैं कि this interest rate is going to get cut, right? And it will be made like whatever 4.5% or 4% or 3%. This has been going on for the last 1.5 years. Now stock market में क्या होता है कि since this stock has been going on for the last 1.5 years, this has already reflected or completely absorbed in the markets to begin with. So one could argue that so far, when we are sitting in September of 2024, all this news has been factored in. So as a result, when the Feds actually cut the interest rate, it's not necessary that the markets will start rallying. So this is the first key point that you must understand कि ऐसा नहीं होता कि news आती है and then only the stocks react or the stock markets react. This news is anticipated. It is almost given that interest rates are going to get cut, and therefore this news or this entire macro data point has now been fully factored into the market as it appears. So this brings us to the second point कि अच्छा तो फिर इसका ये मतलब हुआ कि okay, if the interest rates are cut, okay fine, it's a great thing, but does it mean that the markets will fall? Because you had shown a chart earlier जहाँ पे दिखाया था आपने, and I will pull that chart up again, that in 2007 interest rates were high, they were cut, and the stock market also fell by 58%. Something similar कि interest rates high here, they were cut, and the stock market again fell by 35%. Something similar might happen in 2024 कि interest rates high here, right? I mean here we are at 5.5%. They will cut and the stock market will also fall. So will this happen? Will that not happen? Well, this is very hard thing to judge, but there are a couple of points that I would like to tell you. The first key point is that when we talk about this 2007 phase or this 2019 phase or this 2000 phase, what was happening was that there was some kind of crisis. For example, this was the dot-com bubble. This was the 2008 banking crisis. And this was COVID, right? So it's not as if that the Fed cut the interest rate and the markets went down. Basically what happened was that, for example, in 2000, the crisis was already blown, the dot-com crisis, the company started to crash, the market started falling, and then the Fed decided to cut the interest rate. So yes, it appears that the Fed actually cut the interest rate and the market fell because of it, but that is not correct. Something similar happened in 2008 also, कि वहाँ पे there was real estate crisis, the subprime mortgage crisis. The crisis was blowing up, the banks were collapsing, bunch of different problems were happening, and as a result, the Fed had to come down and cut the interest rates in order to somewhat lessen the shock from that crisis. Again, something similar happened in 2019. So what I'm trying to tell you is that if we analyze the situation in 2024, yes, here the interest rates are high, but what type of crisis is blowing up right now? The short answer is that there is no crisis that is blowing up right now. One could argue that maybe stocks are overvalued, maybe we are in euphoria, maybe that is always up for debate, but unlike 2000, unlike 2008, unlike 2019, there is no crisis blowing up right now. So yes, on one side, you can read articles like these where they are doing forecasting, you know what, there is a very high chance that the stock market will correct this, that stuff. And on the flip side, you can actually apply brain and see that there is no crisis blowing up right now. There could be something that might happen. There could be some new information that might come up. I cannot take guarantee of that. But panicking right now in the market does not solve anything. It's not as if that you should cut your positions, go away, all that stuff. So this brings us to the second key question that, okay, then do I have nothing to worry about? Can I continue to be a long-term investor? Kabhi mera nuksan hi nahi ho sakta, all that stuff. So for this, you need to know the nitty-gritties of interest rate cuts. Now, basically what economists are predicting is this chart, and basically I'll just quickly explain it, what this means. What they are saying is that, see, if you look at the year 2024, then the consensus is that we will reach 5% right now. So right now we are at roughly 5.5% lending rate or interest rate. We will reach 5% this year. In 2025, the consensus seems to be somewhere around 4%. Then in 2026, the consensus seems to be somewhere around 3%. Now go back and take a look at this chart again. So if we analyze the phase somewhere around 2009 to 2014, 2015, the interest rates were close to zero. We were on a very low interest rate environment. Right now, we are still in a fairly high interest rate environment. Now, this impacts a country like India more because in India, the cost of borrowing is very, very high. Just say, for example, if you borrow to buy a house in Dubai, then the bank's lending rate are close to 5.5%. But in India, the borrowing rate for home loans is close to 9%, 9.5%, 10% maybe. So the point I'm trying to make is that the borrowing cost in India is very high, and even in 2026, it is likely to be high. This is a very important, insightful point that literally no one is talking about right now. And this has major implications for the stock market. So this brings us to the third question that, okay, अब interest rate cut होगा, तो will the stock market go up? Will the stock market go down? Will the stock market go sideways? This depends on two specific points. One is regarding the GDP growth rate, right? And second is the valuation. Now, let me talk about valuations first. That right now the stocks seem to be high. That everyone is saying that, you know what, 26,000 पे Nifty पहुंच चुका है. Can it fall? Yes, absolutely. It can fall by 10-15% any day, right? I'm literally saying it out loud, very clear, unequivocal terms. These type of corrections happen very frequently. In fact, if you check the last 3 to 4 year data, you will at least see 4 to 5 times Nifty has corrected by more than 10%. And in the last 2-3 years, there has not been any major crisis like something like COVID or 2008 or the dot-com bubble type of crisis. The second factor is much more in our control in terms of analysis. So let me explain this chart and then I will jump into it. So basically what this chart shows is that, see, if there is a recession, then the market goes sideways, right? So for example, the interest rate cuts are now likely to happen in September of 24, right? So अगर हम 18-month का view लेते हैं, if we take an 18-month view, then the markets are likely to stay sideways in case there is a recession. But on the flip side, if there is a average scenario, so then we will do like what? There will be growth, right? So we will continue to grow. Now this is very important because recession का हमेशा चलता रहता है कि recession आएगा, नहीं आएगा. Can we use some tools? So yes, we can, and there is a recession probability indicator, and let me just quickly show it to you. So here, what you will see is that right now there is a 56% chance of a recession. Now, recession means that GDP will slow down and there will be negative contraction of GDP for the last 2 quarters. In fact, the latest number for India's GDP also came out. We were expecting 7.1 and I think the GDP growth rate was 6.8. So we have missed the estimate. So it looks like that the GDP is slowing. So this could be one of the reasons why stock market can slow down from this point. But in context of recession, we also need to take a look at the 12-month forward earnings of the company. Now, what is the meaning of forward earnings of the company? So let's imagine that Hindustan Unilever right now does like 100 crores of business. Now, okay, when will the stock price do well? Well, if in the next 12 months, instead of 100 crores, they end up doing 120 crores. So there is a 20% growth rate that happens. Now, what are we estimating? We are estimating the earnings of Hindustan Unilever will grow in the next 12 months. Now, if the earnings of Nifty 50 companies is growing, or if the earnings of Sensex or S&P 500 companies is growing, then this 12-month forward earning EPS growth of the entire index is a positive signal which could indicate that the stock market will not fall. So what does the estimate tell us? So if we take a look at the S&P 500 companies, you will see that they are likely to grow. So there is no problem in terms of the forward estimates for the next 12 months. So one data point indicates that the probability of recession is close to 50%. The second data point, which is the forward EPS, indicates that, you know what, boss, nahi, earnings बढ़ेंगी. ऐसे कोई डरने डरने वाली बात नहीं है. So what is my analysis on this and how am I acting on it and what type of stocks am I rebalancing in my portfolio? So my estimate is that from this point, we will move in a certain range on Nifty. So for example, this range I estimate to be somewhere around 22,000 all the way till 28,000. So this is the range in which we might move over the next 6 to 12 months. So this is my estimate. Now, of course, I can be off, but more importantly, what I'm doing is that I'm actually have cut my positions on overvalued bloated assets and I am holding value or deep value stocks as of now. Now, what do I mean by deep value stocks and how do you go about figuring it out? Well, it's very simple and let me work with 2-3 examples, and tomorrow I'm going to write a detailed post on my member community. So in case you are a serious investor, you like this type of macroeconomic analysis, you can definitely consider joining it. So there are 4 or 5 type of stocks that I feel are likely to do well from this point, provided that they are in that value or deep value zone. Okay, so according to my analysis, these type of 5 businesses or 5 types of companies are going to do well. Number 1 are lending oriented business. For example, abhi recently Bajaj Finance or Bajaj Housing Finance ne IPO announce kiya hai. Massive interest in it. Many companies, for example, Aavas Finances in my portfolio have already started running from April of 2024. They have already given very good run up. Something like Aptus is giving run up now. Should you aggregate these stocks now or not? That's your call, how you are analyzing it. But lending companies, especially when it comes to real estate lending, they are likely to do well. Now, why is that the case? Because aap maan ke chalo ki if the base interest rates are 5.5 and if the estimate is that in the next 1.5 years, the interest rate would be somewhere around like 4%. Then what does this lead to? Well, the EMI payments go low. So there will be a lot of housing activity, a lot of infrastructure development activity, a lot of manufacturing oriented activity that is likely to take place, provided the consumer demand goes up. Now that's another piece of analysis. But to cut the long story short, the housing finance companies are going to benefit really well, and this is one of the reasons why it looks like that Bajaj Housing Finance has IPO'd. The second type of business that is likely to do well is broking business. Now there has been a lot of regulatory changes, lot of heat on FNO, vagera vagera, so the sentiments had been really low. I had picked up Angel One. It had done really well now over the last few weeks. So this area is already breaking out. It's doing well. In addition to this, CAM, CDSL type of stocks are doing really well. There is no problem there. They will do well. Third, I think that these are the dark horses. They are going to do exceptionally well over the next few months. The reason is, again, very simple, that if you take a look at this particular chart, this shows the cash positions on which large institutional investors are sitting. So they are sitting on a lot of cash. This is a point that I had covered earlier on one of my videos also. Basically what it outlines is the money held by big players. Now in India, you must have noticed that in the last 4 years, not much FII or foreign institutional investments have come. Where is this money sitting? Well, it is sitting here. They are sitting on massive cash positions. They will bring it to a market like India. And what type of stocks? Well, high growth industries which are safe. What would those be? Banks, private banks. Again, I will release an updated list on my member community explaining what are undervalued opportunities here. For example, we had picked something like CUB, City Union Bank. It has done really well over the last few months. Then comes manufacturing. यार इसके बारे में मुझे ज़्यादा पता नहीं है. I am researching more. I have not added many manufacturing sector stocks, and same applies to infra stocks. RE, I had Indiabulls Real Estate, which has done really well. In fact, I had made a video on it approximately a year back, and since then it has given 80-90% run up. Small caps, these are very, very good in a low interest rate environment. But in India, the issue is that small caps have given massive rally. This is not the time to buy small caps. At least I am not buying. This is not an advice. Please speak with your astrologer. Please speak with your bank RM. Please speak with your investment advisors, vagera, vagera, and then take their opinion. But my point, I'm just sharing very openly with you that, hey, I'm not buying small caps index as of now. Select small caps, yes, I'm adding because they might make sense. These should be profit-oriented companies as of now. In fact, a better opportunity is to add US-specific indices in small caps and US-specific small caps, which can give a rally because there, the market hasn't given in the small cap sector very much run-up. So these are my viewpoints on the interest rate cut, how it's going to impact. To cut the long story short, there is nothing to worry. Worst case scenario that I see is that the market will move in a range, a plus minus 15% range from this point over the next 6 months. And you should definitely keep an eye out on these select sectors that I am talking about. They can actually give you very good run up in the long term. They are still fairly okayish valued, I would say. And if you pick good quality stocks in these industries, you are likely to make very good money. Thank you so much for watching, and I'll see you soon.